Good afternoon, ladies and gentlemen. First of all, let me introduce to you our top management team who overtook the operation of the company during its 5th year of existence. My name is Kirill, our financial manager, Yauheni, our production manager, Kirill, who's in charge of human resource department, and me, Olga, I'm in charge of marketing. Today we're going to present to you the analysis of the bond company. On the next graph, you can see the global operation summary presented for the year 15. Our company is still operating in its 4 markets, with its major market in Europe, Africa, second largest Asia Pacific, Latin America, and North America. Overall, during the year 15, the company produced 3,139,000 cameras, which were all produced in-house due to the fact that outsourcing could cost us much more money, and it is also beneficial for our company because of low production costs and high productivity of our pets.
On this graph you may see the trends for the revenues of bond company. Starting from year 5 till year 8, the revenues of the company were steadily increasing due to the fact that our company was producing cameras of very high quality, which in turn increased the number of retailers that are willing to sell our cameras. However, after that we introduced new strategy, and as a result number of retailers decreased. And starting from year 11, we introduced a new strategy, which in turn increased the number of retailers again, and we were able to earn more revenues.
Here is presented the earnings per share chart for bond company starting from year 5 till year 15. You can see that the only year that the EPS is way below the investors' expectations is year 7. Our earnings per share dropped to that level because of our strategic mistake referring to the wrong evaluation of competition. However, from year 11 to year 13, our EPS is steadily growing. Currently, in year 15, our EPS is 6 times bigger than it was in year 5. Here is the return on equity trend for bond companies starting from year 5 to year 15. Similarly to the EPS, in year 7 the return on equity is way below the investors' expectations due to the company's strategic mistake referring to the wrong evaluation of competition. However, from year 10 to year 15, the return on equity is steadily growing thanks to the introduction of a new competitive strategy. So currently in year 15, the return on equity is 6 times bigger than it was in year 5. Here is the trend for credit rating, and it's mostly stable except of 1 year, year 7, due to the same mistake we already mentioned. And in year 5, our credit rating is B+, which exactly meets investors' expectations.
Talking about the image of the company, the image rating never fell below the investors' expectations during the 10 years of our management. You can see that starting since year 5 up until the year 8 including, the image rating index is growing, which was due to the fact that company invested sufficient funds in corporate social responsibility. But with the introduction of a new strategy, our image rating dropped a little bit up until the year 12 because the company had to cut its budget to some extent. But then the company stood on its feet again, and starting since year 12 up until year 15, the image rating grew to a big extent.
Here is the chart for stock price for bond company. So you can see that we do not meet investors' expectations only in year 6, 7, and 8. The 7th year is the least stock price for bond company due to the strategic mistake already mentioned. And from year 9 till year 15, the stock price is steadily growing, and currently in year 15 the stock price is $145, which is 7 times bigger than it was in year 5.
When the new management team was introduced, the company was already operating for 5 years on the market, and we realized that the company needs a new vision, which is to become a leading provider of cameras that has a strong brand affiliation among our targets. So we plan to become a global leader company in the digital camera industry by providing high-quality multi-featured cameras and medium-quality entry-level cameras at competent price. So we also intend to conquer the market shares in our target markets by practicing strategic marketing investments and investing in innovations.
Here you can see performance targets for the year 16 and 17. EPS for year 16 is going to be $11.5, while for year 17 is going to increase up to $12.5. We expect EPS to grow due to the fact that the number of retailers is steadily growing, and we are planning to earn much more revenues, which will result in higher earnings per share. Return on equity for year 16 is going to be approximately 71%, while for year 17 it's going to grow up to 73%. We also expect return on equity to grow because we are trying to earn much more money from our productions, and which will increase our return on equity. The credit rating of a company for year 16 is going to be A-, while for year 17 is going to increase up to A+. Starting from year 16, the company has to pay out its debt, which will improve the credit rating of the company. Image rating of the company for year 16 is going to be approximately 89, while for year 17 is going to increase up to 92. The company should invest sufficient amounts of money in corporate social responsibility, and that will in turn increase its image rating. Stock price for year 16 is also going to increase up to $170, while for year 17 we expect it to be $190. So as you may see on these performance targets, everything is going to grow. So our company used two strategies for entry-level segment. Starting at year 6 till year 11, our company used low-cost leadership strategy. We produced entry-level cameras at a low cost, but we also have to sell it at a low price. This resulted in higher market share, and we were able to sell much more cameras. However, we changed our strategy at year 12. We introduced global best cost strategy due to the fact that long-term investment in new product research and development brought some results, and we were able to produce cameras at a lower price, but those cameras were of a higher quality. For multi-featured segment, we used three strategies. First strategy was in year 6 and 7. It was global differentiation strategy. We tried to produce cameras of very high quality. However, the strategy failed due to the fact that we paid little attention to our operating profits, and we had to introduce new strategy, which was low-cost leadership strategy. It was introduced at year 8 until year 11. Our company produced cameras at a lower quality, and we also sold those cameras at a lower price. And after that, the number of retailers started to decrease, and we had to introduce a new strategy. It was global differentiation strategy. We introduced it at the year 11 until year 15. We increased the number of retailers due to high PQ rating, and which in turn increased the number of units demanded by our retailers. It increased our revenues and profit. Our production strategy was not to use outsourcing. Our company tried to make full use of parts which were available at the company and hire temporary ones to produce more cameras in-house. Moreover, the company used overtime to avoid outsourcing.
The financial strategy of bond company is presented below. The only mistake bond company made in the beginning of its operation is the issue of 1,004,000 shares of common stock in year 6 in order to raise additional capital. This decreased our stock price and we considered that it was too early to issue shares. Since that time, the financial strategy of bond company is stable over time. The shares of common stock were repurchased in order to boost earnings per share and return on equity. In year 15, bond company achieved the minimum allowed shares of stock, 7,005,000 shares. This led to such high indicators as earnings per share, about $8.37, return on equity almost 70%, and stock price of $145. Actually, the return on investment of bond company was among the 20 best return on investment in year 15 worldwide.
Regarding the entry-level market, we consider such companies as Digital Image, Fantastic Four and Centaurus as our main competitors because their market shares, prices and PQ ratings are similar to ours to some extent. What concerns multi-featured market segment, we consider such companies as Digital Image, Fantastic Four and G-Box as our main competitors, as their strategies are at this level that are highly competing.
Talking about the overall assessment of competition that one company is facing right now, in the long-term perspective, all the companies are perceived as competitors and as the trends in the industry signal that there is a high trend of change in strategies. Moreover, all of the companies are perceived as competitors in order to avoid any unexpected competitive activity from the companies that were not considered as our competitors before.
So recommendation to our compete our rivals. We suggest new management team to invest sufficient amount of money in new product research and development because it's a long-term investment which boosts PQ rating of cameras, and as a result the company can produce cameras at a higher quality but at a lower costs. We also recommend the company minimize production costs because the company is going to produce cameras at low costs, which will result in lower prices. So the production costs have to be very low. The company has to invent new marketing strategy. However, we suggest new management not to invest a lot of money in marketing because it will increase marketing expenses, which in turn results in lower operating profit, and the company will not be so profitable as it was before. One of the main disadvantages of our multi-featured segment is the fact that we produce only 3 models of multi-featured cameras, while the number of models produced in the industry average is 4.3 models in the industry. We also suggest new management strategically invest money in corporate social responsibility, which will improve company image rating. However, the company has to make those investments very wisely. In order to keep market share very high and even gain new market share, the company has to provide its products on decent prices. We suggest new management steadily decrease its prices for entry-level and multi-featured cameras in order to gain more market share and gain more revenues.
Now to end our presentation, our management team would like to present the lessons that we learned during our Globus experience, and the first lesson would be setting clear goals, which means that our top management team actually had to set clear goals and objectives before developing any strategy and actually executing it.
One more lesson we learned is to plan ahead. Our management team realized the importance of long-term planning and long-term investments.
We also have learned that we don't need to underestimate competition. Underestimating competition can lead to unexpected rivalry, and also rivalry can come up with reducing market share and profitability.
One more lesson that we learned during the evaluations of the company from year 5 to year 15 is to keep track of production costs and operating profit. These are actually the crucial factors which influence your profitability and sales.
Moreover, we learned how to make full use of all available resources, for example, in finance field. We learned how to use our resources at the end of the year, for example, to pay out our debt.
And finally, never give up. Our company did a good job at introducing a new strategy at the end of the 7th year of our operation. Because if we would never actually did introduce the new strategy, we would never reach the condition that the bond company is in right now.
So thank you for your attention.